Let me now bring on board Sandeep Singhal, co-head institutional equity derivatives with Emkay Global Financial. Sandeep, morning. Thank you for joining us. What are you telling your clients? How should they trade and make money in a volatile market environment?
Mostly this market is stock pickers market, and we have very clear preferred picks in the sectors. So it's not really a market to take beta and go whole hog in any stock where the growth story is, but to really scan through the various gamut of stocks and look for values. So that is what we are advising our market to focus on stocks, not really on the indices.
Sandeep, stock picking works when global markets are okay and when local markets are looking stable. Currently, globally things are in a mess. Locally also things are in a mess. So why are you advising your clients to pick stocks when the big picture is shaky?
See, we service long-only investors who have compulsion to invest because they have been given money by investors really to invest, not to stay in cash. So their mandate is to stay invested and outperform the indices, and that is the reason we have to continuously keep on advising like where the best investment options is actually. So that is typically the reason. As long as you can outperform the index, whether in the falling market or rising market, as a fund manager your job is done, and as a sell side that is our mandate.
Sandeep, just want to get your thoughts on the CCI report and how damaging could it be for the cement pack at a time when the cement stocks are holding up so well?
It's very, very interesting proposition, and this particular hangover is continuously be on cement sector for quite some time, like 4 to 6 weeks now. Market is desperately expecting any time this order to come, and our worry is not really the quantum of penalty, but what exactly they cite in the order, like what would be the changed business environment going forward, whether post this order cement companies would be able to hold on to their pricing power and continue to enjoy the EBITDA margin they are presently enjoying. So given the very low weightage in the overall index and the market cap, it's not really too much of a worrisome factor from a market rise or fall viewpoint. But yes, for the cement sector, it's an interesting proposition. Given all the current environment, offering CCI order in offering, we are placed in large cap. We are preferring ACC at current valuation over Gujarat Ambuja, and in the mid cap space, our best picks are Shri Cement and Madras Cement actually.
Sandeep, your top investment idea for next 1 year with one line on it, why?
Like in pharma stocks, we are preferring Ranbaxy in the large cap space, typically because Ranbaxy would keep on enjoying less price erosion in Lipitor and more market share, so that would give an edge over the current valuation at 17 times their FY13 earnings. It's a very good buy in our view. In IT space, we prefer Infosys, HCL, Tech and TCS in the same order. Infosys available at about 15x and steep discount to TCS, and most of the execution issues are things of the past, so that is the stock we prefer in the large cap IT space. In IT mid cap space, we strongly prefer Hexaware and Mindtree. Hexaware is offering you about 5% dividend yield, and stock has continuously given very good result in terms of company. They are expanding the margin for last consecutive 4 quarters, and we expect them to continue expanding the margin.
Mid-cap pharma stocks, they appreciated, and they appreciated quite smartly in the last half an hour of trade on Tuesday. So let's look at some intradays here. Lupin, Ajanta Pharma, Divi's, Strides. Mid-cap pharma stocks appreciated, and they appreciated on strong volumes on Tuesday afternoon. Sandeep Singhal, my question is why?
See, market is very clearly aligned to have a portfolio where the higher weightage is given to IT, FMCG and pharma. Like FMCG stocks, given the valuation they are quoting, they lever 30 plus kind of a P. Where can you go overweight in these stocks? IT, you would try to go overweight because for the overall IT sector, the weightage in the index is really on the lower end, and surely it would rise. Then the things come
Sandeep,
to pharma.
Can I challenge your argument there when you say that markets are hiding into defensives? Because if I look at the price action for Asian Paints, Bata, TTK Prestige, Jubilant Foodworks, VIP, which are popular consumption names, all of them are down. All of them are down 20% in last 1 month.
You are right, actually. If you really go back 3 to 4 quarters, and since then the industrial growth is going down and we see GDP going down, then what really happening? People who were overweight FMCG and liver went to very exorbitant kind of evaluation, and Asian Paint, etc. Then they have cut weight, and we have seen, post the declaration of this quarter result and previous quarter result, when you see top line growth sliding down, so those who are really want to take the bet early, they have shed their weights in these consumer stocks, by slight margins, but still no one is really underweight. Actually, they must be equal weight or slightly overweight, and that is the reason that they have really fallen. Now the question is that if the top line further shrinks, whether these stocks would be able to hold on where they are or will fall further. That is what we need to see. So that is what I wanted to say, that within these three sectors now, I as a fund manager might prefer to go into Infosys or some mid-cap pharma names or Ranbaxy kind of a stock than lever. That is my argument.